Record first and share. All right. So, like I said, thank you very much for joining this webinar. Today, we're going to be talking about exit planning, exiting your business, and the different types of exit options. For those of you that haven't been in the series, we've been done several webinars already talking about overall themes around exit planning. We have a couple of those webinars as recordings on our websites, but if you're interested in seeing those, let me know. We're also going to be doing some from future standpoint as well. If there's other themes that you would like to see, let me know. But let's go ahead and dive in. So to start off, I'm Ethan Stewart. Of those that do not know me, I own Centennial Financial Group. We're a holistic wealth management firm, and I wear two main hats. The first is I'm a certified financial planner, but today we're going to be talking about the second hat, which is the Certified Exit Planning Advisor, or the CEPA, which helps companies and business owners position themselves to get the maximum value and to go and to move into retirement and comfortable pace. So today we're going to be talking about a couple different goals. We're going to be talking about I'm not going to spend a lot of time, but we're going to be talking about what is exit planning, what does that look like. We're going to be talking about first steps, where to start in deciding what exit option you should go after, and then the type of exit options, team game, what kind of team you should start surrounding yourself with, and then next steps and how we can help moving forward. So how we're going to do questions. If you guys have any questions, we're a smaller group today. So if you have any questions, please go ahead and raise your hand or type the question into the Q&A. And Christine will pass the question on to me as we move forward. But that's how we're going to go ahead and do it today. So to start off for the group, I have a question for everybody, and that is, having a transition strategy is important for both my future and the future of my business. What do you guys think? Go ahead and type in the Q&A or what everyone thinks. It could just be quick, but I'm just curious on what your thoughts are.
One person said yes, another said absolutely.
Yep. I agree. It's kind of I'm teeing you up a little bit here, but that is a very important theme of exit planning. Is to, one theme you'll be hearing me say is that exit planning is smart business and it adds value to your business just thinking about it overall. And I know everyone's different, and every situation is different, but to start off, I want to kind of put a quote out there. So the certified exit planning advisor. We run through a organization called the Exit Planning Institute, and they release a state of owner readiness questionnaire periodically. And so I wanted to start off with this information that about 99% of owners agreed with the statement having a transition strategy is important for both future and the future of the business. However, what comes along with that is that about 79% of owners have no written transition plan, 49% have done no planning at all, and 94 have no written personal third act plan. So my point of this is that although there's a need and people agree with it, actually implementing and putting together something to solve that problem is a challenge and an opportunity for people to cover. And that's what we're going to be talking about today. So to start off, what is exit planning? So an exit plan attempts to ask and answer all the questions around business, personal, and financial questions to put you as the business owner in the best position possible, as well as the business, to be able to comfortably go into that next stage of your life. And as we go through this presentation, you'll hear me call it the next stage of your life, or the next, the third act is also what I like referring it to as. I'm not calling it retirement, because if you are a business owner, like any other ones that I work with or know, then you agree with the statement that retirement isn't necessarily stopping. It's more about creating the lifestyle that you want. And so, because sometimes that's working part-time or being involved in the sub business at some capacity, because you work so hard and build this entity that's almost your baby. It's not just so easy to take a step back and forget about it. And that's one of the challenges of exit planning is not only position the business right, but position you as the business owner as well to take a step back. Again, we go into this in some of our other webinars a little more, but I did want to mention that and why it's so important. So we'll be talking a lot about the business, personal, and financial questions that balance more here in this webinar. Another thing that we'll be talking about is exit planning really needs to create a paradigm shift for the business. So there's a business owner, there's a mentality shift that needs to happen to put your perspective into certain things and certain lenses. And one of those is this focus on holistic financial planning. So a concept in the SEPA world, in our methodology world, that I really like utilizing is this concept called the three legs of the stool. And the analogy is that a stool needs all three legs balancing properly to actually be a good stool and actually balance and function the way it should. And why I like that metaphor is because you need all three of these things balanced. You need the business to be in a good place to not only take a step back, but also to capitalize on, and also to be able to run with or without you. You need personally to be ready to take a step back and excited for what happens afterwards. Otherwise, the exit probably won't happen. And then finally, you need the financial piece to be lined up. You need the finances lined up properly in the business as well as personal to be able to do and go into the third stage of your life as well. So you really need all three pieces properly balanced. And exit planning is the big process in doing just that, or prioritizes doing that. So that's the first paradigm shift is thinking about getting all three of those pieces properly structured. What I've found is a lot of business owners tend to have a couple of these taken care of. Most of the time, it's business and financial or personal, meaning that the business is their main asset and maybe their personal side, they're ready for the next stage, but they don't have any assets outside of the business, or vice versa. Maybe they're financially all ready to go as well as business all ready to go, but maybe they as a person aren't necessarily ready to go in the other two stages. So it's really finding the balance of all three that is part of the process and exit planning. Now, the second paradigm shift that business owners should start thinking about is exit strategy is good business strategy. Now, a challenge that a lot of business owners run into is thinking about, I'm not ready, or that I don't need it right now because I'm not taking a step back. But the reality of the situation is that exit planning in anticipation for that it adds value to the business all on its own. If I'm coming to look at potentially purchasing your business, for example, I would want to see that the business is set up that if something were to suddenly happen during that transition or during our negotiations, that the business can still function relatively well from an owner perspective. I'd want to see that. Or without the owner, I should say. So it adds the process of getting things prepared for an exit, even if you don't decide to do it, adds value to the business in general. So exit strategy is good business strategy is a very good approach from a business standpoint. Now, a lot of people find that, or I found that a lot of people are doing this unintentionally. The key is doing it deliberately and starting to get very organized around what's required to do that. So, and again, exit planning is planning for the future, but we really make the strategies that put it in place today, right now, in the present stages. So, hopefully that makes sense to you guys. Let me know if there's any questions on that. But that is the second paradigm shift that needs to be done. The third paradigm shift is adopt a common framework. So there's a lot in exit planning. It can be a very complicated process. It can be a very long, lengthy process. It can also be relatively simple, but I don't think there's any situation that it's not somewhat complicated. So having a framework you can rely on how to properly get things positioned and actually go through the exit planning process is very valuable. So the methodology that I'll be referring to today and that we use through the SEPA and the exit planning approach is what's called the value acceleration methodology. It's a process that's proven that if you walk through the different steps of assessing the value, of preparing it for the preparing the business to get what value you need out of the business, and then finally deciding whether to sell or continue to raise the value is a very good methodology to be used to be able to either exit properly and or increase the value of your business until you decide to exit properly as well. And frankly, as a business owner, you know, any business that does not utilize systems and does not have a framework to fall back on tends to fall apart the more complicated it gets. So just like systems in the business allowing you to do your business in a more efficient way, a framework allows you to exit in a more efficient way as well. So we're going to go over a little bit about the framework and how it works, things along those lines. Again, I won't spend too much time because I want to go into the types of exits, but I do want to touch on it briefly. So this is in the value acceleration methodology. There's this concept called the 5, 4, 3, 2, 1 concept, or these several concepts that can be summarized in that. 5 stages of value maturity, how to increase value using the 5 stages. The 4 intangible capitals, which is arguably the most important way to increase value of your business if you're not getting what you want. The 3 gaps, which is identifying how much financially you need to cover certain gaps in the business as well as financial to balance that 3 legs of the stool. 2 concurrent paths, knowing what path to walk from a business and personal end. And then finally, 1 goal, which in the end is to exit. So again, I'm going to go over these relatively quick. Go ahead and put in the Q&A if you have any questions on these from Christine, and she'll let me know if you do have any questions. So the 5 stages of value maturity, we'll start on that. And that is the identify, protect, build, harvest, and manage. So what this means is there's 5 main stages while building value in a company. And that is, especially with this can be kind of applied in the maturity stages. It's similar to the maturity stages of business, can be applied similarly. But what I'm referring to here is the exit planning and adding value in the business itself. We first want to identify the opportunities, the weaknesses, the things that could be worked on in the business. We want to look at that first. Second thing we want to look at is protecting value as much as possible. There's a concept called the 5 Ds, which are situations that can disrupt the quality of the business because something happens to the owner. And some examples are death, disability, divorce, decide, things along those lines. Those are all things that can quickly affect the value if something were to happen to the owner. So protecting using various strategies, techniques like insurances and other things add surprisingly a lot of value very easily to the business in general by protecting the value around the owner. Building is one of the more time consuming. That's when you actually start building the business using the methodologies that we'll be talking about in the different methodology from a business perspective to improve the business itself. Start harvesting some of the value after you start building some of the value in the company, and then finally managing whatever value you get out of the business once you successfully exit. This is kind of the progression that we take you through to utilize the methodology and have a successful exit because all those things can be done separately, but as a whole, that enables you to have the most successful exit that you can. Now, some people from a business standpoint maybe at the half of their business at the value that they want to be able to get what they need in retirement, which is called the wealth gap, which we'll talk about in a second. Some people don't. So this concept is called the 4 intangible capitals, and this is where about 80% of value, true value of a business lies, is in these intangible capitals. These are the concepts that aren't necessarily quantitative, meaning that they don't necessarily show up on a spreadsheet, but they tend to give most of the value of a business when a purchaser comes to and looks and assesses the business, whether they want to buy it or not. And some of those are customer value, Do you have a diversified customer value, or do you have one big customer? If I'm coming to buy your business and you have one big customer, that gives a little more risk to me. Human capital. Do I have a good amount of, do I have a good team built up, or do I have a terrible team, high turnover, maybe they're close to retirement, etc. One has more value than not. Social, is the business, do they have a good culture? Is it a business people want to work at versus one that sucks the life out of everyone? There's one good and one bad. Structural, do you have the systems? Does the business have the systems that are set up, or is it very reliant on the owner? Things along those lines. Now, there's a large range of what those can be, but the point is that those are tend to be the most valuable things that you can focus on to scale the value of the business in general. And it really, by focusing in on this concept, making them simple, it helps to focus in and get more intentional of the growth of the business itself. And then the third bullet point there, readiness versus attractiveness, that allows you to work intentionally to make your business not only more ready, but also more attractive. And there is a difference. So if I'm coming to buy a business, there I want to see a business that is set up and have more of these. It's more attractive to me versus readiness. It may be more attractive, but the business owner needs to be ready to take a step back as well and have these things set up to get what they want out of it. So this is a very important concept in growing the value of the business itself, which again, today isn't mainly about that, but that's also something to keep in mind. Now, the three gaps is something I've been mentioning, and then this concept is the first is wealth gap, and that is the gap that you need to fill by the sale of the business to be able to go to the next stage of your life. And we have that personal first. We like to have that gap covered first because we need to know if you're going to exit your business, we need to know how much you should or need to sell the business for to provide enough for your family and take care of what you want after that or after you successfully exit the business. That is arguably the most important gap, because if you sell your business and don't get what you need, then what's the point, right? So there's a lot of need to make sure that we have that value gap or the wealth gap properly covered. Profit gap is the gap between the profitability of your company and best in class in the industry. Understanding what kind of gaps there are from a profitability standpoint allows you to work on the business and increase the value in the business to cover that profit gap to make it more attractive. Value gap is very similar except different in terms of it looks at the value or what the multiples and the sale value of the best in class in the industry is versus where your company may be. It gives an idea of, are you on track of being one of the more valuable ones? Is there room to improve? Are you near the top already? Things along those lines gives us some guidance on what kind of goal we're getting for to be able to cover the other gaps as well. And one other thing I wanted to point out on these gaps, and this isn't a gap piece, but through this process of assessing these gaps, we want to look at a couple things. Real number versus tax number. As any accountant will tell you, there's different ways that numbers from a business standpoint can be represented, and there's a real number is what we're looking for. And the difference between that is a tax number will show some of the draws and the costs associated with an owner, versus what we want to focus on is what's called the real number. And that is the number that takes out those things. Because again, if we're looking to exit the business, the owner will no longer be here and will no longer have some of these costs associated with the owner. So we want to know the overall value or the real number that is not that the business has without the owner involved, because that's really what the potential purchaser is going to be looking at. So this is another concept that you should get familiar with. The two concurrent paths are the paths of business and personal. So this is an interesting concept about, as most business owners know, especially when you're getting started, business and personal tend to be meshed together. Well, when we do business exit planning, we want to try to separate them and plan accordingly on both ends. We want to plan for the inevitable or the planned taking a step back of the business owner, So we need a plan for both. We need a plan for getting value from the business as well as get value in the our personal side. So what this means is you want to work on the business versus in it. And as any business owner knows, that's easier said than done up front. But there is a point where you can put systems in place, put people in place to help you work on the engine itself. There's a really good book if anybody's interested, The E-Myth Revisited. It's an excellent one. There's a bunch of other ones, but that's particularly good at talking about working on the business and looking at it as almost a machine that you want to be able to run itself with anybody at the helm versus somebody that, versus a machine that only the owner can run. And if the owner goes away, the business goes away. So that's the goal of these kind of paths is we want the business to be able to run itself. And then we want you to be ready to be run yourself as well. And that's particularly important for a couple of reasons. First off, financially, that's pretty straightforward. But this third bullet point here, 75% of owners profoundly regret selling after 1 year is a surprising and a staggering statistic. And oftentimes this happens because the owner did not get what they wanted out of the business. They did not exit how they wanted to. And that's the difference between an intentional and unintentional exit, which again, we talk about a little more in some other presentations. But also, oftentimes a business owner sells and they didn't really want to sell. And that's the personal side is you want to, again, you build something, worked your whole life on building an entity that oftentimes is very valuable. You want to sell it the way you want to, your baby, right? You don't want to just give it over to anybody. You want to be ready to move forward. And oftentimes that's associated with what happens after the business. If I sell my business, what do I have? What's my purpose? Oftentimes, looking at after the business is just as important because you need to be excited for that. Otherwise, deals oftentimes will fall short. And that statistic is representative of it. Another statistic that isn't listed here is that I think it's around 80% of business owners tend to be the cause. The cold feet tends to be the cause of most deals falling through, and that's because again, business owners don't recognize what's going to happen next, aren't excited for the next step, and so they let the deal fall through because they really don't want to. That's why it's so important to think personally as well. And finally, there's really only one main goal in the exit planning. You, as the business owner, are the driver of this, and the goal is to get value and to exit the way that you want in the best way possible. Now, you want to do it by balancing those three legs of the stool in the best way possible, but you really want to exit the proper way, utilizing everything that you can, doing it successfully, doing it enough so you get what you need to give you the fulfillment and purpose and the excitement for exiting your business, not the regret that is very much possible when doing it right. Okay, so the next concept we want to talk, well, before we get into the main kind of main point of this webinar, I first wanted to show you the value acceleration methodology. So this is a visual that kind of breaks it down. So on the left, you'll see this discover gate. So we are going to be starting talking about discovering, and then we're going to be talking about this third piece and spending most of the time on this third piece of deciding when you actually want to build the business. On other webinars, we talk about this middle part, which is the prepare, which is preparing the business and growing value, but we're not going to be touching on that too much. So to start, we're talking where to start with the type of exits you should look at. What exit options you should look at starts with this one, believe it or not. And this gate one is what is called in the methodology is when you assess and start gathering information and begin planning things out. But in terms of the exit options, this is really where you start identifying what exit option is best for you because you're identifying the goals. And that's why it's the first step. So first step in this is starting to ask some questions about when we're actually getting towards exiting, start asking the proper questions. What's the goal? What happens? What do you want out of the business itself, the exit itself? What happens afterwards? how much money do you need, how much money will the business contribute to your next stage in life or your retirement, things along those lines. All of those start dictating what value you need today to be able to create the personal, financial, and business planning that's necessary for a successful exit. And by getting those goals broken down, starts helping to answer the question of what is what is the proper exit option for you to take. Now, there's a lot more to this that I'm not touching on because again, I want to today's webinar is more about the exit options than this first step. But in this first step, you all start identifying those gaps. What gap? How much do you need when you sell your business? How much do I need to increase the value for my business? Who are the stakeholders in this overall process? Who do I want to take care of? Things along those lines. It really starts identifying, getting everything clear to be able to move forward. And in terms of exit options, we take this information to then take it over to the third gate or the third stage, which is when you decide to sell the business or not. In which case, what do we actually look for in an exit option? So some of the questions that you'll ask around the goals is for the owner's side, how much do you need? What's the financial goals of the owner? How much do you want to take, if anything? How much do you want to live off of? Things along those lines. What's the financial goals of the business owner? Ease. This is often a consideration is when you look at the different exit options, what kind of ease a business owner wants. This is a consideration, believe it or not. Some business owners just don't want to deal with it and just want to make it as easy as possible. Some of them want the proper exit that they've always envisioned, so they don't mind about it being a little more complicated. Spoiler alert: it's always a little complicated, but there's some that are more straightforward than not others. Transition: how long of a transition time frame do we want? Who's going to transition, what that looks like. Some business owners I've found like what they do so much that they're going to stay around for some time and transition things in their own terms, and that's perfectly fine. Here's the deal, guys, is that exit planning can be however you want it, but we first need to understand what you want to be able to design the exit plan around that. There's no set way to do it. There's a lot of flexibility in how it's done. The key is to understand what you want out of those and for you to understand what options and what things you need to think about. And some other things to take into account is the other stakeholders. If there are any stakeholders, what do they want? Now, because you are kind of the driver of this whole process as the person exiting, you're the main, the main person on this. It's your decision, right? And then just you're a baby to do what you want to do. But oftentimes there's other stakeholders, especially in like family businesses. For those of you that aren't aware, I purchased my business from my grandfather a few years ago, and that's how I got into this space. So I'm intimately aware of the challenges and opportunities that a family business transition actually represent. But that's only family. Maybe there's a partner in play that you built the business with. Maybe there's like a key management team or a really good team of employees. There's a lot of in all scenarios and all exits. There's oftentimes more stakeholders than there seem, and so understanding everybody's goals with yours as the priority, but also other stakeholders to take into account helps to design what exit options to actually look for. Okay. I'm gonna pause really quick. Any questions so far? If so, go ahead and type in the Q&A. Okay, no problem. If so, Christine will let me know. Okay, so we're gonna go ahead and skip that middle part, like I said, and go straight towards the third gate, if you will. And in this gate, this is kind of the main part of exit planning. It is essentially deciding to keep or deciding to sell. Now, and that's why it's called the decide gate. That's in the end what you're looking for. So we're not going to talk about the keep because essentially what you're doing is asking that question, growing or exit. And you do this through a cycle of 90-day sprints and a methodology to make sure that you understand what you need to do, what opportunities there are, et cetera, et cetera. And so you would ask the question of what risk reward do I have if I want to keep it? In other words, if I kept it and took the time to build on the business and get more of what I need for it to create the value I want, is it worth it or is it not? Again, we're not talking to you today too much about that. So we're looking at, okay, the answer is no, I don't want to keep it. I want to look at actually selling and start initiating the exit options. So there are a couple of options on how to do that, or processes. We first want to look at what options we have, which again, we'll talk about here in a second. You want to compare the options, what are the best based on your goals of the first gate, as well as what everyone, all the stakeholders want. You then select the best option for you, your goals, and your situation. And then finally, you start initiating the plan and initiating and executing things to successfully get that transition done. So let's start talking about the actual exit options. So now there's some micro versions of these, but from the overall perspective, there's two main types of exit options, or two main categories, I should say, and that is inside. So this is a exit options that have some sort of internal mechanisms, some sort of stakeholders that were already inside the business, not outside, versus outside, which are the vice versa, is people that are not internal stakeholders in the business looking to purchase the business for various reasons. There's pros, cons on both. So today I'm going to be going through all of them high level, talk about pros and cons, what situations you may look for in them, and really just go through these. So again, if you have any questions on these, just type in the Q&A, and Christina will read them out and let me know what options they have. So we're going to go ahead and start with internal and talk through those first. So I know some of you on this call, and oftentimes, especially around us, more people than not are interested in this one. So I wanted to start with this, and that is intergenerational transfer, or selling to a family owner, or the family in some capacity. Usually it's an heir, usually children. Ideally, most business owners start wanting to exercise this. 50% of business owners want to exercise this option, but in reality, only around 30% do. And that makes sense because you need the other buy-in, right? Ideally, you build something for your kids, but they need to want it at the same time, at least in some capacity. So that's why sometimes this becomes a not the primary option, depending on what the kids want to do. Some people are lucky enough to have somebody assume that role. Some people are lucky enough to have a grandchild come and swoop in and help with this. But the point is, you are selling to family, which has their own challenges. So the pros of this is that you have some business legacy preservation in theory, because it's family. People like seeing a family business, but also having a legacy, having and being able to mentor somebody as close as family to ensure that the business continues the legacy that you built, you spent so long to build, can be very, very positive for a lot of business owners. I know that when me and my grandfather first started, we weren't sure whether to advertise that I was his grandson or not, but we found that a lot of people were very positively responsive to that. So family can be a very good thing. Family-oriented business can be a very positive thing for people and customers. It can be very planned. It can be over a period of time, as little as long as you want it. Really, it could be over a lifetime. There's that advantage of mentoring and slowly exposing the family member to the business itself. Tends to be lower cost because you're kind of implementing them up front, and in the business in some capacity, and there's more flexibility on how it's done because your family, you're able to be a little more flexible on things. You as a business owner have more control. You can transition things the way you want to, again, because you have that relationship there and that trust. There's less disruption oftentimes because of that long control, or that long transition. The business itself is less disrupted because you have employees that start building a relationship with that successor. You have the successor getting familiar with different systems, things along those lines. So it can be very successful from a minimal disruption standpoint. And oftentimes there's really high buyer and seller. There's various relationships, obviously, in family, but in theory, family wants to make sure that family is taken care of. So oftentimes the buyer and seller are both highly motivated, not only for their benefit, but also the other person's benefit, which helps from a negotiation standpoint. Now, there's also, don't get me wrong, this is all warm and fuzzy, but there's also plenty of cons with family business. Family dynamics. Families can be, as you guys know, or as some people may know, very challenging. I think everybody knows in some capacity, families can be challenging. But for example, me and my grandfather, I would call it a successful exit because we both transitioned. We're both happy with our position. But there, don't get me wrong, even in a successful one, there were definitely some, especially up front, challenges we faced, not only from a financial standpoint, but also with just personalities and the just who's taking over, things along those lines, just challenges that can come up because you're family, and so there's ways around that. You need to work through it, but what we found is that it needs to be worked through, but communication always helps, and there's solutions to this, but those can come up quite a bit and need to be addressed, and can be cons in some ways. I've heard a lot worse horror stories of this. So there's different ranges of that. Lack of funds and illiquid buyers. So oftentimes the buyer may not have the money that can be brought to the table like a third party buyer could, for example. So there's always that understanding that there might be some illiquidity or challenge to actually come up with the money. Now, again, there's solutions around this, but that can be another con. Lower sale price, so you will not get the massive amount of windfall you would if somebody wants to buy your business versus a family. Again, because you as the seller may not want to, squeeze your loved one, but at the same time, they probably won't expect as much. So there's oftentimes you'll see a little lower sale price here. Key employee flight risk. Sometimes you see this happening is that a key employee may expect to take over the business, but then when it goes to a business or a family member, they get upset about that, or there might be a lack of trust around that new family member. So this dynamic has to be taken account. Again, there's ways to offset that through communication and strategy, but that's oftentimes a con. Tradition may outstrip a good strategy. This is a challenge that's unique to this, is that the family member that takes over may be honoring the traditions or things that the way that it was done from the seller's perspective without looking at the strategy. So there may be some bias or blinders of what should be done versus what is done because it's done. And then path of least resistance. It's not always a path to grow or for growth or success. It might just be the easiest, which may not necessarily be a good thing. So that's intergenerational. Management buyout. Now, management buyout is where you look and have a trusted manager or trusted management team. They are the ones that end up buying the owner out in some capacity, or partner, or buy a portion, etc. So some of the pros of this is, again, continuity. You have somebody trusted that knows the business to continue the business. Oftentimes they're highly motivated because it's viewed as the next stage of their growth from a career standpoint. As they're managers now, then they become partners or owners. Preserves key human capital. And what this means is you preserve the people. If you have good managers, then this can be viewed as the next promotion by getting them into a ownership capacity. It can be very planned. Again, similar to the intergenerational, it could be over a period of time. Can be combined with private equity to get the resources needed to actually create this, things along those lines. Now, some cons along this, because it's don't get me wrong, again, it's not all good things. Some cons is that the management can be sandbagging, meaning that they can position themselves as ready, but in reality they're not. They can be very distracted because they're busy actually managing the business as opposed to owning the business. Threat of flight, once again, They could coerce the owner to take a worse deal because they're starting to threaten that they're going to leave and they might be essential. A liquid buy, illiquid buyers, again, they might not have the capital to be able to buy out. Lower price and unattractive deal terms. This is another example of, you probably won't get as much out of this as you could with a strategic buyer, for example. Oftentimes, the owner has to finance a lot of this, similar to intergenerational, because they may not have the money to buy out. And then a really important point is the managers do not necessarily mean and make good business owners. So that's another thing that needs to be taken into account. But this is another good option for internal. Another option for internal is sale to partners. Now, this is similar to managers, except instead of managers or family, you sell to partners. If you have somebody that is a part owner of the business, or maybe you have some sort of buy-sell agreement in place, then this is an option. Now, obviously, if you're the only owner, doesn't apply. But some pros, less disruptive. This is usually pretty smooth, very planned, very similar to all the other two. Well-informed buyers, this is a big one, is that if you have a partner doing the same day to day, then great, you have somebody that's about the best potential buyer that you could get because they're just as aware as you are, especially in a good partnership. It can be a very controlled process because you guys have oftentimes the same intimate knowledge of the business itself. And oftentimes it can be lower cost because, again, both of you are in the same position essentially, and one is just buying out the other. Now, some of the cons is, again, you'll get a lower sale price, and this varies, but it's usually agreed upon or you know what it is, so it tends to be a little lower. There's potential discord. Good partners are different than bad partners, especially in a sale. Bad partners can become almost a forced exit. I have a few stories of that, but for time I won't go into that. But that can be a big problem in disagreement and not being able to agree on how exit should happen. Competency gaps, as any good partnership knows, usually one partner excels at one thing and the other does the other. So oftentimes, if you take out one of them, there's a gap there from a skill standpoint. Buy sell may restrict selling options, meaning that there might be restrictions around some sort of buy sell agreement. And then realization of proceeds is often slower because because of the nature of the deal itself. Sale to employees. Now, this one I won't get deep into, but it's an excellent tool, is the ESOP, and that is the ESOP, Employer Stock Ownership Plans. This is a strategy and a approach that enables you to sell to your employees. So similar to a manager, except you allow ownership to an employee overall. So this is a very interesting and yet very complicated tool, but it is one of the best if you have a really, really strong culture, really good employees you want to take care of, and you want to look at passing the business on to somebody. This might be an option for you. Some of the pros is business stays in family. It's people that you trust, i.e., your employees, the people you build a good culture and business with. Um, Shares purchased with pre-tax dollars. I'm not going to go too much into the tax stuff because for time, but also complication. But essentially, ESOP can be one of the most tax efficient vehicles for business owners if done correctly. It allows a lot of deferral of taxes, which a lot of people like. There's a lot of creative things you can do with it. But that's why also it's one of the more complicated things. ESOP is an excellent employee benefit. Saying that your plan and your company has an ESOP can add a lot of value and retention as well as attraction. And employees, as any owner knows, if you have ownership mentality of an employee, there's more value there. So it helps to kind of shift that mentality. Some of the cons may be it's a very complicated and expensive, especially compared to other options, but it can be very excellent when done correctly. So this, more than anything, tends to be needing a expert brought in. You can't just have an everyday Joe execute this. A team tends to be the best for this, and we'll get to that in a second. Require securities registration exemption. So there's again, unique requirements causing the complication of this that are necessary. The company is required, or the ESOP program, if an employee leaves or wants to sell their share, the company has to buy back their shares, which can cause cash flow issues. And then this is generally best done when you have time and you want to see a gradual exit for, again, because of the complicated nature of the ESOP as well. But I could do a whole webinar on just the ESOP. So it's a very interesting option. And if you guys are ever interested in hearing more about that, let us know. Okay. Christine, do we have any questions?
Nope, no questions right now.
Okay. All right. Moving on to external exit options. So the first is sale to a third-party buyer. Now, who this buyer is can vary. Some of the big ones are strategic buyer. You will get no other money more than a strategic buyer. Somebody who wants to buy your business for strategic reasons will give you the best ROI in terms of what you can sell your business for. Financial buyers, another opportunity, private equity group, and these things can all be the same thing. But this is a third party entity that wants to purchase your business. So some of the pros is, like I said, this has the potential to get you the most value of your business, your highest price tag for the business itself. You can ask for more cash up front for the business, which would benefit you just from a simplicity standpoint. Because you get more cash up front, oftentimes you can walk away faster. There's a lot more stability of deal terms because you have a transparent, formal negotiation process. Everybody is aware. You have your attorneys involved, so everyone's aware of what happens, and it's pretty quick and simple and not vague on what happens. Business refresh, oftentimes there can be a nice business refresh if you find the right buyer. It can oftentimes improve the business itself and the business entity and what you want out of it overall. But it can really help with a refresh. It can be very cost effective, meaning that the sale of the business can be more cost effective for the seller as well as the buyer. And then it can break any sort of deadlock. So if you have some headaches or personality headbutting on a management level or the family level, then it can help break that as well. So a lot of good positives there, but let's switch to the other side because there's plenty of cons to understand. It can be a long process due to due diligence and other factors. It can take more time. There can be a lot of distraction and loss of focus from the business because it takes a lot of time. So a business owner has to run through all these hoops, so it can take away from their ability to run the business. Privacy concerns. Some people may not like sharing the information to a third party. It can be very emotional for business to an owner to, you built your baby and then to expose yourself to a third party to see, there's a good book out there called Your Baby's Ugly. And that idea of that you're exposing yourself, your business to a third party to get a true unbiased view of do you think is the business good or not? So it can be very emotional. Post-sale tie downs, oftentimes there can be some restrictions that happen afterwards, such as like do not competes and other things. It can be the highest cost option due to the professionals that need to be paid, the complicated nature. It can be very costly and it can be very complex. And finally, it can be very difficult to close because of the negotiation nature. The next one is recapitalization. So this is essentially refunding the business. It's getting some extra business or some extra capital by selling portions of the business to somebody. Sometimes it could be a lender and it could be through collateral. So there's ways to get extra cash quickly. Some pros is it allows you to do some partial exits. Doing only a portion, sell a portion, reduces owner risk. It helps diversify by having another person involved, provides growth capital, and provides capital that's necessary in the business. Taking a second bite of the apple, another person taking a look at the business helps, another perspective. And this can work well with other exit options as well. You don't have to have it separate from some of the other ones. This can be a little more flexible in terms of the options. Now, again, some cons is you're selling equity, so you're losing control, and now you're establishing accountability to other partners, which can be negative. It can create a culture shift by adding in another perspective. It can slow down a transaction, and it can also be expensive relative to the benefit that it presents. This isn't as the other ones, which is one of the reasons I'm flying through it. This is a little different, but this is also another option as well. And then finally, orderly liquidation. This is not the one that people want to go after, to be frank, but it is an option. And there's some options, or there's some businesses where this is actually better option than some of the other ones. And that's where you liquidate all your assets. You don't sell, you just try to look to liquidate. So where this is beneficial, and pretty much the only place it's beneficial is when you have a business that has assets that far exceeds the value of the business itself. For example, in a real estate enterprise that has just hard assets such as real estate or some manufacturing, etc., that's where this can be beneficial in some ways, because the sum of the parts are greater than the whole. That's the calculation that will need to be done. It's very efficient, very easy way because you're just selling everything, and it can be less expensive because of that. Now, there's a lot of cons, and one of them is you're not really sure what you'll get because now you're looking for the best prices for the sale of things that can vary. There's no money for goodwill or how good the business is. It's what the business is worth, what the assets are worth at the time. Again, it can be very emotional because as a business owner, you work so hard to build this business, and suddenly all you're selling is the assets. That can be looked at as negative, and that's along those lines is the stigma around it. Some people look at a liquidation as negative, which again doesn't necessarily have to be, and it can hurt employees and jobs because you're selling the business but not continuing it. So you're selling it and liquidating it, and the business is then going to be closed down and very well could be higher tax. This option is the worst for the seller from a tax standpoint, especially with as a C corporation. Stock sale tends to be better for the seller, so that also needs to be taken into account. Now, I know we're getting up to time, so I'm going to run through this last bit pretty quick so I can have a few minutes for questions. So to kind of summarize, so we talked about all the options, and as you can see, there's a lot of complication in there. So I want to end by expressing that exit planning is very much a team game. It requires a lot of professionals to be working in conjunction, sometimes unique professionals being brought in to make sure that you not only get the best value, but you find and select the proper exit option and get the best value for your buck that you can in this process. And there may be some additional professionals that are needed outside of what we call the core team, which I'll get to in a second, that are needed depending on the situation. So these are the main core team needed for a successful exit. The first is a certified exit planning advisor. You need one of these to make sure that this whole process goes to coordinate the actual exit process, to coordinate the other professionals. That's the big role of the SEPA, is to keep everything organized and on task so the owner doesn't have to worry about it. Is to the way I like to think about it is almost the general contractor on a contracting or a construction job is coordinating all these people. They're not going to be swinging the hammer. They're not going to be putting in electric, but they're going to be making sure you find the best person for the job. They're going to be making sure that it's all done correctly up to standards and while aligning with what the owner wants first and foremost. The financial planner or the financial advisor is the second, one of the more important ones. These are the people that are going to help identify the wealth gap, help to not only position you financially as you go through this process, but also afterwards to make sure that you enjoy the lifestyle you want in the most efficient way. CPA, professional accountant, is huge. We want to make sure you pay the taxes you owe, not unnecessary taxes. So being as tax efficient in this process is essential. And then finally, an attorney and or slash estate attorney, because both can be used, or one or the other. There might be some separation of that. But somebody to help navigate the legalities, the negotiations, no matter what option is chosen, is essential in this process. And some examples of some additional members that may be needed are an M&A advisor to help actually sell the business, estate planner to help plan things if something were to happen. I've seen family business advisor to help have those conversations and coordinate complicated family dynamics. Growth consultant to help actually grow the value of the business. Board of directors, et cetera, et cetera. But this is again the purpose of the SEPA is to start bringing in some of these other professionals and recognizing when they are needed. So as you can see, to wrap up, exit planning can oftentimes be very complex. There's many factors to consider. And as a business owner, you know how important it is to actually ask for help and look at getting somebody to help you through this overall process. And as you know, action is the most important thing, actually following up and doing. Don't be the type of owner that has not anticipated or has not worked on this. Be the one that is ahead of the curve and actually starts executing on this and having those conversations. So the question is, are you ready to begin? Again, action is everything. You can't get where you are without it. Action is everything. You got to execute. Ideas are great, but if there's no action behind it, it doesn't matter. It's time to use where you want to go. Last few things as a thank you for coming. We're offering a complimentary 30-minute Ask Anything session. So if you're interested, please reach out and I'd be happy to jump on a call with you, or me or my team would be happy to jump on a call and talk with you and ask any questions, additional questions you may have. And then we will send a recording to you. Feel free to pause this screen when you get the recording to learn more about exit planning through our website, as well as join our newsletter if you would like. But finally, this is information if you want to get in touch with us, but I will leave the last few minutes for any questions. So if you do have any questions, feel free to type them into the Q&A and Christine will read them off and we'll get them answered. But otherwise, I very much thank you for your time. Thank you for taking the time out of your day to pay attention, and we'll go ahead and answer any questions.
I do not have any questions at the moment.
Okay. All right, we'll wait a few minutes, but I think that will be it. Okay. Well, this is my contact. If you have any questions, don't hesitate to reach out. Again, thank you for your time. Thank you for your attention. Thank you for taking the time out of your day. And I hope you have a great one. And we look forward to hearing from you. Thanks so much, guys.